Hey Desert Life family, thank you for tuning in. So there are some of you who are sitting on some serious equity right now, and you may be wondering if you should utilize it or let it continue to grow. So today we are going to discuss the difference between a HELOC, home equity line of credit, and a home equity loan, the pros and the cons. Now before we get into all of this good stuff, please subscribe, give this video a thumbs up, and share this video and the channel with your family and friends. So plenty of homeowners use the equity in their homes for home improvement projects, large expenses like education, or even to purchase investment properties. We are personally considering using equity to replace our roof and update our bathroom because both of these are large expenses, and using equity is one way to afford these type of projects. That is, if you're not sitting on that type of cash or you have it lying around. Although there are some differences between a HELOC and a home equity loan, they both allow you to borrow against the appraised value of your house. A HELOC, or home equity line of credit, is exactly that, a revolving line of credit. It's like a credit card, but your home is the collateral. So basically you have a line of credit available and you only use it on an as-needed basis, and you can continue to use the funds as you repay them. You only pay interest on the money you use, but you need to know that most HELOCs charge variable interest rates, meaning the rate will fluctuate. So for example, we are currently experiencing high interest rates, and they're really fluctuating at the time due to inflation and other economic conditions. So you can expect the interest rates on a HELOC to be high or fluctuate as well, or move along with whatever the Fed set. Well, now on the flip side of that, which is actually an advantage to a HELOC, the interest rates for HELOCs are often lower than other types of loans or credit cards because the loan is secured by your home. Now, the draw period on a HELOC is typically 10 years, during which you can access the credit line. After the draw period ends, you enter the repayment period, which can last up to 20 years. During this time, you must make payments on the principal and interest until the loan is fully repaid. Now, some advantages of a HELOC are: number one, you can borrow as much or as little as you need. Number two, because this is a revolving line of credit, you can borrow and repay the funds as many times as you want during the draw period. Number three, lower interest rates, like I said before, in comparison to other types of loans. And number four, the paid interest may be tax deductible. Some disadvantages are, now since this is a variable rate loan, the payments fluctuate. If you're not disciplined with a budget, or if you are an impulse buyer, you may not use the funds wisely. And if you don't repay the loan, you may lose your house. A home equity loan is a fixed term loan that gives you a lump sum of money, and it's very similar to a conventional fixed rate mortgage. This is similar to a HELOC because number one, it offers a lower interest rate in comparison to other types of loans, and number two, your house is the collateral. It's different, however, because you receive a lump sum of money instead of a revolving access to cash. It needs to be repaid for a fixed period of time, typically in monthly installments. And the repayment term can range from 5 to 30 years, depending on the lender and the amount borrowed. Now, when you apply for a home equity loan, the lender typically requires an appraisal of your home to determine its value. Now, the amount you are able to borrow will depend on the amount of equity you have in your home, your credit score, and other factors. Some advantages of a home equity loan are: number one, the amount is fixed, so mismanaging funds are less likely to happen. Number two, monthly payments are fixed because it is a fixed rate loan. And number three, interest rates in comparison to other types of loan are lower, and the paid interest may be tax deductible as well. Now, some disadvantages include you cannot access more money without having to take out another loan. If you want a better rate, you will have to refinance, and if you don't repay the loan, of course, like a HELOC, you may lose your home. Now, the question is, when should you use one or the other? First, determine the purpose of the loan. Home equity loans are good for large expenses like remodeling, paying for college or a form of education, even a down payment on an investment property. HELOCs are good for emergencies, home repairs, or even smaller scale home projects. Now, there are pros and cons to both type of loans, and you will have to determine which one best fits your needs. Now, if you're considering a HELOC or a home loan to upgrade your house, then you will definitely need a copy of my book, Selling Secrets You Can't Afford to Miss, where, as a matter of fact, in chapter 6, I discuss upgrading with ROI in mind. So click the link below to get your copy. And if you have any questions, I'll be more than happy to answer them. Click the other link below to schedule a chat session. I'm Renee the Realtor. Thanks for tuning in, and we'll see you in the next video.